Hey guys, you click that link, you're wanting to know more things about an investment property that could provide you additional wealth or additional aspects that are great to have that you might not have thought of. So stay tuned to the end and we'll talk about a few more. Hey guys, real quick before we get in that video, my name is James Dean with James Dean My Real Estate Team, and I just wanted to make sure if you haven't done this already, make sure you hit that subscription button down below, the notification bell. What that does is keeps you notified every time we come up with a new video. We do at least 2 a week, and I just want to keep you updated and just cool things to do, cool things to see out here within the Woodland Park and Teller County area, and you get to see a little bit of how I like living my life out here as well. If you've got any questions or comments, please don't hesitate. Give me a call, shoot me a text at 719-266-2725. You can also email me at info@jdmret.net, and I will get back to you as fast as I can to answer any of those questions or comments. And if you've got any real estate needs out here whatsoever, please, once again, don't hesitate. Give me a call or shoot me that email or that text. This is James Dean with James Dean My Real Estate Team, the team leader here, and I absolutely love living here, and I love helping people out here in this area too. Hope you guys like this video. Okay guys, today we're talking about additional benefits of investment property. So it's not just the cash flow you're getting from your renters and then the appreciation of the property itself as it goes up in value and you build your net worth within that side. We're also going to be looking at some different things that you can get out of a property that's very unique and very different than other types of investments that you can't get, but you can get on real estate. Now, obviously, one of the biggest ones is tax depreciation. So most folks, if you've looked at any kind of real estate investments, has seen the tax depreciation side of all of this. And I just want to caveat all of this with, number one, I'm not an attorney. So if you're seeking legal advice, seek an attorney, not me, on any of this. And they will clarify a lot of this stuff on the legal side. I'm also not an accountant or a CPA. So I'm just giving you some broad strokes on this to talk with your accountant or CPA on so that you can actually have some smart things to talk about. And we'll talk a little bit about some different types of CPAs and accountants out there also as we kind of go through this as well. So tax depreciation. What is tax depreciation? Well, to put it in its most simplest form, let's say we have a $400,000 piece of property. So the land, you can't depreciate the land. Let's say the land is worth $100,000. You can't depreciate that land out there at all. What you can depreciate is the improvement that is on that land. And the reason why is because as an investment, you are paying taxes on the income you're receiving from that land. You're paying taxes on the appreciation on it. You're paying taxes on the income from tenants that come through there as well. However, that entity, that improvement, that building, that home, that barn, whatever you have on the land, it's not going to be there forever. It's going to deteriorate over time. Homes get older, buildings get older. They need to be upgraded. They need to be renovated. They fall down if they're super old. I mean, we don't see homes and buildings that are still up here from the Roman Empire, unless you're in Italy and you see the Colosseum and stuff, you see that it's deteriorating. It's very obvious. So we can all know and understand that we're on that same sheet. So what the US government has done is they provided the ability to depreciate over time. Now this depreciation happens on an annual basis and they give you certain percentages that they let you depreciate, and your CPA will be able to walk you through all of that stuff as well, and it's for the improvements on the land. Now let's say in that example, $400,000 piece of land, you got a $200,000 building on it, so that's the $200,000 appreciation. Well, that other $100,000 in the value of the land are going to be your other assets like your windows, your doors on there, your furnishings if you've got a short-term rental, different things that don't necessarily translate. They can translate into that exact improvement, and you can depreciate that $300,000 over the entire length of that depreciation time frame. But there's a new thing that I just heard about today. It's on the Bigger Pockets podcast. Highly recommend, if you're looking at real estate investing, definitely listen to that podcast. Awesome podcast. But they had a CPA on there and they were talking about segregated depreciation. I have never heard this term before. This was fascinating to me. And with this, I'm hoping to start tax strategizing this month, which would be December timeframe of 2022, so that I can strategize for what I'm going to do tax-wise next year in 2023 for any kind of properties that I purchase. Segregated depreciation, what it allows you to do is take things that depreciate at a faster value. I think I'd have to go back and look at it again. Once again, I'm not a CPA, so I might have the years wrong in this. But things that depreciate faster than 7 years on there, so don't have a 7-year lifespan typically, and you're able to take that and you get basically, it's like it's almost like an audit of your place, of your building that you pay for, that a professional comes out and does, and they establish a value for that and itemize it for you, and then you can depreciate that entire value in 1 year. So in our example of the $400,000 piece of property that you bought, and it's got furnishings and all this other stuff, let's say it's a short-term rental that's out there, so you have $100,000 to the land. Land never depreciates. Land's not going away. Land is always going to be there. So it's always going to be there. It should always increase in value, and that's not something that'll depreciate. The building, however, is your depreciation on there, and you can segregate that out with the stuff that's supposed to last less than 7 years on that, and get a depreciation that's set up in that year on that. So in this example specifically, we're looking at tax depreciations that would normally on an improvement on a property last for 3 decades nearly, that's going to take time for it to go through on and to actually push through and to actually get your proper depreciation on there. And I know I'm going to have people watch this and they're going to give me the exact dates. Oh, it's 28 years for a short term and it's 38 years for a long term or something along those lines. I'm not here to give those numbers right now. I'm not here to give those numbers of what that looks like. I'm just giving you broad strokes so you can go and you can talk to your tax consultant on this to figure out what you're looking at, your tax strategist really, to see how you can actually capitalize on this. If you haven't heard these terms or thought of these terms, definitely ask them about this. So with the segregated depreciation on there, we take that additional stuff that's less than 7 years, and let's say it's $100,000 in that example, and that year alone, you can depreciate that against what you've made on your property that year. So you can then turn that into where you're not paying really any taxes at all on that. Now, before we get into, and I know we're gonna have all these people, oh, you're not paying your part, you're not doing all your things for taxes. Well, I'm gonna strongly disagree with you on all of that, because what an investor is doing when they actually purchase a piece of property is so much in value for both the economy as well as a tenant that's living in there, and the taxes that they are paying, they are going to pay when they actually do sell the place, because if they're depreciating the value on the home itself, when they do sell it, if they don't roll it in with the 1031, which is very difficult to do, it is possible, but you're just deferring at that point. You are eventually going to pay taxes and all that, and it's going to be at a much higher amount than when you first purchased the property. So it's just a deferment of tax. This is really all that we're looking at. And as we depreciate, we're actually looking at and guiding that and getting that in. And I would strongly suggest that you probably use TurboTax to find out what kind of tax deductions you can get on the income that you had as well. It's the same thing, just in a different type of mindset on this. So with that segregated depreciation, with somebody that's built wealth within that real estate investment realm, they can look at this. They don't have to do it all in the same year they purchase. Also, talk to your tax advisor on that as well, your tax strategist. But you can actually do that separately in different properties to help you out with that, so that you can get more properties and invest in more properties and actually grow the economy in a lot of ways. For me, it was an eye opener on that, because I did not know or understand that. I mean, it's insane the differences that can make with what you're paying in taxes that year. So, and we've talked a little bit about tax consultants, tax advisors, tax strategists, all that stuff. So this is something else to look at too. I did not know this, as I'm getting into this investment cycle and getting into an investment business plan and game plan moving into this. Understanding the different types of CPAs and tax consultants that are out there. Or you got bookkeepers that don't necessarily need to be a CPA. There's somebody that goes out there and they basically help you do your line items for your business, line items for your investment properties, and they line all those expenses up with those incomes, and they're basically keeping track of all that stuff on your ledger for that as well. You have your tax preparers, which most people are probably very familiar with. A tax preparer program would be TurboTax. It's basically where they're helping you do your taxes that you're submitting for the year. They're helping you submit them correctly, do them the right way that the IRS needs to, so you're not getting audited, hopefully, and that you've got everything set up and it's done properly when that gets submitted to the IRS. And then this is a new term that I'm experimenting with, and I'm going to see, and I believe that my CPA does this for me as well, but I'm going to sit down with them, and it's called tax strategist. Now, this is the person that you sit down with before the end of the year. You want to talk about your taxes, making sure you're set up for this year. You've got everything set aside that you need to for those taxes being paid this year, but you're also going to be going into your next year, how to strategize in your next year, and how you're going to be planning stuff out and working through things so that you've got your quarterly updates or month to month, however you want to do that stuff as well. This person typically costs a lot more money. They're a lot more experienced on this as well, and they're going to be able to help guide you through that. Now, you need somebody that's not just a tax strategist to go through that, but they need to be a real estate tax strategist as well, because there's just different aspects of real estate that you'll never look at with other different parts of the economy or different parts of tax strategizing that can actually go through. So certainly important to look at that too, but definitely some terms that you guys need to go out there, talk to your CPAs on with as well. And that's stuff that I'll be doing too. Now, the last thing we're going to talk about in this video, and one of the benefits of owning real estate, and I talk about this so often, and I just feel like it's just one of those parts that just kind of just gets glazed over all the time, but that's inflation on there. Real estate is the absolute best. I wouldn't say the best, it is one of the best engines to be in for making sure you're maintaining the value of your money. So if you take $100,000 and you plop that in the bank is going to give you a small percentage on it, but they're not going to give you more than what they're going to be paying inflation-wise on it. And then they've got to be able to use that for lending. There's a whole different gambit of business models that goes for banks on that. But your $100,000, typically you're going to be sitting there, you might be getting 1% if you're lucky in that account, but it's sitting there doing nothing. When you look at years like the year we just had, and you're looking at inflation sitting at 7, 8, 9% on that, that's your $100,000 sitting there in that bank account, and it's not gaining any value at all. It's sitting there, it's losing value while it's sitting there doing nothing. Now, there's certain times when it's important to have cash that's available for emergency funds, for things that you've got planned, but having your cash just sit there doing nothing, if you got large amounts that's past that amount you need for emergency fund, is ridiculous, and you're losing money on it, sometimes quicker than you could put it in there as well. So certainly something to think about. When you compare that to if it was in real estate, during this period that we've seen this massive inflation, we've also seen real estate markets skyrocket during it as well, which is part of what that inflation's the government's trying to slow down. The housing market, as well as inflation on top of that. Now, I know of no time in U.S. history when there was deflation on the dollar out there at all. It's always been inflation. Having that money in the property, in the actual residence that's on there, and letting it increase in value with the appreciation of that property, which normally is higher than what inflation is anyways on there as it continues to go up. And oh, by the way, your money sitting in there, if you've got $40,000 cash from a down payment or whatever, that's the equity that you actually paid into the home and you got the loan on there. As that home appreciates, it's appreciating on the full value of the home that the loan is on, which is going to make it easily surpass what the interest rate is on that home as well. But you've only got that cash that's in there plus the payments you're making on it. You're not going to have that full amount, so you're going to gain a lot more than what the inflation value is on that as well when you decide to sell or if you decide to pull more money out of that. But residency, we just talked about depreciation and land. Land is never going to depreciate because it's not going anywhere. There's always a finite amount of it too. You're not just going to make more land. They're going to decide to build more places, but there's only a finite amount of land. There's only a finite amount of resources out there for that land too, which is always going to drive the demand up because there's always going to be a limited ability to supply a whole lot more, especially as population increases too. So I know we talked about a lot of different crazy aspects of this. I'm probably going to get some harsh comments, but I don't care. That's my opinion. That's my philosophy on this. That's what I believe in for real estate investing. And I hope this at least taught you something, at least to get into either bigger pockets or into one of these more specific and detailed books like the ones I'm reading right now that can help you learn even more about this, because I think this stuff is absolutely fascinating and I really hope it helps you guys out. I really hope you guys enjoyed that video. Don't forget, if you've got any questions, comments, whatever you've got, please send them to me. You can call or text me at 719-266-2725. You can also email me at info@jdmret.net. I would love to be your local real estate agent. I'd love to be your local expert. So anything, it doesn't have to be real estate related, please don't hesitate to ask. Let me know what those questions are and I will get them right back to you. I look forward to seeing you guys next time.